Hello, my name is Steve Bigelow with the Candlestick Forum. We're seeing a bearish trend now in the market. After the big up day, the knee-jerk reaction to the Fed announcement, you could see how the Dow started drifting and then sold off pretty hard on Friday, with it trading back below the T-line. Now you add the analysis that not only did the knee-jerk reaction get negated by the NASDAQ, but it completely negated any of the upward trading or the bullish trading after the announcement. Even though it didn't trade down very much on Friday, you can pretty much see that this downtrend is in progress, or because we're below the T-line, it still has to be assumed that that obviously we're not in a Santa rally at this point. So I would stay short. We can see that same confirmation on the bearish side over here on the S&P 500 with the dark cloud right here at the kind of a resistance level. And then notice what it did on Friday. This is why you always want to use the relevance of the T-line. Notice where they took the S&P 500 to, right smack dab to the T-line, and then sold off. So if they open, or if we wake up tomorrow morning and the pre-market futures are showing weaker trading, figure that at least the S&P is coming back down to this level. So this is making some of the biotechs acting strong, but building materials are good shorts. So we've recommended some of the biotechs based upon their buy signals, especially right here at support levels. And want to take a look at DCPH, another biotech. You can see the big fry pan bottom. If it breaks out through this level, you got a lot of running room, or at least heading back up to this level. So keep an eye on the patterns, because obviously you can see that they were buying this one on Friday when the markets were selling off. But there is a heck of a lot of good short position setups. The building materials are selling off pretty hard. You can see how they reversed this and did kind of an evening star signal failure at the T-line. But you can also see that if they open this lower on Monday, you got a bearish Doji sandwich, which likely means they're at least heading back down to this level. The bearish Doji sandwich is very informative, and you can see on Cisco Foods how the they failed here at the 34, closed below the T-line. This one can be shorted with at least your first target here, your second target being a wave 3 to the downside. But the Doji sandwiches, Dillard's, one of the retailers, if this opens lower, not only does it tell you have a Doji sandwich, but breaks this level, also putting you in a wave 1, wave 2, going into wave 3. QCOM, same scenario. If it opens lower, bearish Doji sandwich after a failure of a fry pan bottom at this level. And Apple, you've got a dark cloud. This is just candlestick common sense, that if you have one bearish signal and then followed by another bearish signal and a close below the T-line, if this opens lower on Monday, get ready for a bearish Doji sandwich or continued downtrend. So right now, with this market not trading above the T-line, with the implication we're heading in this direction, you want to stay predominantly short in this market. That'll be it. We'll see you in the chat rooms.